I was catching up with a retired manufacturing executive the other day. We were talking about the gold rush of the late 90s and early 2000s. He had this smug, nostalgic look on his face as he described moving his company's production lines to Guangdong. He described it like finding a glitch in the matrix. He even showed me a photo on his phone of the boat he bought with his bonuses back then, laughing about how they paid the overseas workers pennies while selling the finished products here for top dollar. To him, it was the ultimate victory of Western business brilliance. We used their cheap labor, we got the profits, and they got the scraps. But the mood shifted instantly when I asked him a simple question. So, who owns the market share today? Your old company or that Chinese partner? He went quiet. The smile vanished. He stared at his coffee and finally mumbled that his old company was bought out years ago, while that cheap manufacturing partner is now a global tech giant. He suddenly got defensive, his tone turning bitter, complaining that they didn't play fair and that their money was manipulated. That sudden shift, from the arrogance of exploiting a weak currency to the realization that he was the one being played, perfectly captures the greatest economic illusion of our lifetime. We are told that a weak currency is a sign of a failing nation, a badge of shame. But looking at that executive's defeat, I realized we had it backward. What if keeping money worthless wasn't a sign of collapse, but a cold, calculated weapon? While the West was celebrating cheap TVs and high stock prices, a trap was quietly snapping shut. Okay, let's unpack this. That story, it really suggests we need to look past the surface idea that a weakening currency always means national collapse.
It does. It forces us to investigate the innovative strategic paradigm that this whole situation presents.
Right. So our mission today for this deep dive is to explore how currency management and foreign exchange reserves were transformed. They weren't just a passive consequence of trade, but a powerful, multi-decade lever.
A lever for, profound national industrialization, global supply chain dominance, and, of course, immense financial influence.
That's a huge topic.
What's really fascinating here is that we're examining a system where currency stability is, intentionally managed. It's not left to the market. It's managed to serve national development goals.
Which just turns conventional economic wisdom completely on its head.
Completely. This analysis shows how a multi-decade strategic approach, specifically through this managed appreciation, became a pivotal enabler for rapid industrialization and, as you said, building that robust global supply chain dominance. We're looking at currency not just as an accounting tool, but as a core engine of deliberate industrial policy.
Okay, so let's start at the very beginning of that engine. We have to understand the fundamental mechanism that generates all this wealth in the first place, which is the trade surplus.
Exactly. The entire economic model was, for decades, built around being a manufacturing and export powerhouse.
The world's factory.
The world's factory. And for decades, especially relative to the U.S., that resulted in these massive, continuous trade surpluses. Goods ship out, and foreign currency, mostly U.S. dollars, comes flooding back in.
So that constant inflow of foreign money, of dollars, it creates an immediate, almost mechanical challenge for their central banking system, right?
It's an immediate problem you have to solve every single day. Just think about any Chinese exporter who's selling products internationally. They get paid in U.S. dollars.
But they can't use those dollars to pay their workers.
Precisely. They have domestic bills to pay. They need to pay their thousands of factory workers, buy local components, cover all their operational costs in the local currency, the renminbi or RMB.
So on a daily basis, you have these vast amounts of U.S. dollars entering the system, and at the same time, every exporter is trying to convert those dollars into RMB.
Which creates a predictable and absolutely massive imbalance in the domestic foreign exchange market. You have a huge supply of dollars chasing what is effectively an artificial scarcity of RMB.
In any standard, free-floating currency system, one that's just driven by market dynamics, that flood of dollars and the intense demand for RMB would lead to one thing.
One inevitable outcome: rapid appreciation of the RMB. The value of their currency would skyrocket.
Which sounds good on paper. A strong currency means a strong nation, right?
Right.
That's the conventional wisdom.
It is, but for an economy laser-focused on exports, it's a self-destructive phenomenon. It's the last thing you want.
Because if the RMB appreciates, Chinese exports instantly become more expensive on the international market.
And you lose that crucial price competitiveness. That loss of business isn't just a line on a spreadsheet. It translates directly into a massive employment crisis.
An existential threat to the whole model.
Absolutely, because if you understand that securing mass employment and ensuring social stability are the fundamental national priorities that underpin all economic policy, then maintaining that export-led growth is simply non-negotiable.
So if the RMB were allowed to float freely, that competitive advantage would just evaporate, and you'd have systemic instability.
You would, and that's a scenario they were determined to avoid.
This is where the strategic intervention comes in. The People's Bank of China, the PBOC, they don't just let the market decide.
No, they step in. They essentially act as the ultimate market stabilizer and, crucially, the buyer of last resort for all those excess US dollars flooding into the system.
So they're the ones standing on the other side of that trade, buying up all the dollars the exporters want to sell.
That is the core of the strategy. The PBOC intervenes by actively acquiring the surplus USD from the exporters. In exchange, the PBOC supplies them with the domestic currency they need, the RMB.
And because they're the central bank, they can create as much RMB as they need to make those various purchases.
That's the key. The central bank holds the authority to print the domestic currency as required, so this process can be sustained, well, indefinitely. This continuous intervention artificially maintains a scarcity of USD relative to the demand for RMB.
Which keeps the RMB lower or weaker than it would be in a truly free market.
Exactly. This action achieves the primary policy objective, maintaining low export prices. But, of course, there's an immediate and massive side effect.
Right. If you're constantly buying up all those dollars, you have to put them somewhere.
And that's how you create what the world now refers to as this astounding hoard of foreign exchange or FX reserves.
The scale of this accumulation is just siskin. It's historic.
It is. It really accelerated dramatically in the early 2000s. And part of that was driven by accommodative monetary policies in advanced economies. Low interest rates in the West led to a surge of international capital flowing into emerging markets for investment and speculation.
So money was looking for a better return, and China was the prime destination.
It was. And that just added fuel to the fire. China's reserves grew from just $154.7 billion in the year 2000.
$154 billion is a lot of money, but it's nothing compared to where it went.
It's a rounding error. It shot up to an almost unbelievable peak of $3.99 trillion by June of 2014.
$4 trillion.
Nearly. And while the reserves have stabilized more around the $3 trillion mark in recent years, this vast stockpile remains the largest foreign exchange reserve in the world by far. This accumulation isn't an accident. It's a direct required consequence of the currency management we're describing.
It's the raw material for the next stage of the strategy.
Exactly. It's the raw material for financial statecraft.
Okay, but this whole operation seems to fly in the face of a classic concept in international economics, the impossible trinity.
It does. The impossible trinity is this hard constraint that economists talk about. It says a country cannot simultaneously pursue three goals.
Right. You can't have it all.
You can't. The three goals are: first, completely free capital flows across your borders. Second, an independent monetary policy, meaning you can set your own interest rates. And third, a stable or fixed exchange rate. You have to sacrifice one.
And China's choice seems pretty clear. They've obviously prioritized managing the exchange rate to stay competitive, and they've maintained an independent monetary policy to steer the domestic economy.
Which means they had to sacrifice the third leg of that stool.
Free movement of capital.
That's the strategic choice. They managed this balance by imposing strict, non-liberalized control on international capital mobility. The capital account, the system that tracks all these international investments, has remained highly controlled. And this high level of state-dominated control over the economy is absolutely crucial for the whole system to function.
Why is that internal control so essential? Because if your central bank is constantly printing RMB to buy foreign currency, wouldn't that traditionally lead to a massive inflationary spiral at home?
That is the textbook expectation, yes. In an economy with free capital flows, that's exactly what you'd see.
So why didn't it happen?
Because China maintains that tight control, they can implement policies to essentially sterilize the inflow of domestic currency. They can issue bonds, raise reserve requirements for banks. They have tools to soak up that extra liquidity.
So they can manage and direct that internal money supply, preventing it from just spiraling into runaway consumer inflation.
Precisely. This allows them to contain the inflationary side effects domestically through policy, while leveraging the export advantage internationally through the managed currency.
So the whole system is built around this one central need: ensuring the RMB is competitive enough to maintain employment and economic stability.
That is the driving rationale, absolutely. If the RMB were allowed to appreciate, that price advantage would vanish and you'd face economic destabilization. So this strategic management of the RMB isn't an oversight or a temporary fix. It is a long-term core policy choice.
sacrificing free market currency determination in favor of securing the conditions for continuous, rapid industrialization.
You've got it.
This is where it gets really interesting, because this is where the true strategic brilliance emerges. Western businesses, like the executive in our opening story, they see a weak currency and low costs, and they just interpret that as cheap labor. They think they're exploiting the system.
Right. They see a simple arbitrage opportunity.
But what the data shows is that the managed currency structure actually created an engineered immense advantage for foreign direct investment, or FDI, that lasted for decades.
The managed currency created a direct and massive financial advantage for any multinational enterprise, any MNE that set up export-oriented production facilities. We call this the production cost channel.
Okay, what does that mean?
It means the MNE produces its goods in China, so its costs, labor, rent, materials are in RMB. But it sells the final product on the global market, so its revenue comes in as foreign currency, like US dollars or Japanese yen.
So the cost base is in one currency and the revenue base is in another. The two are segmented.
Exactly. And because of that segmentation, the strategic devaluation effectively lowers all those local production costs when you measure them back in the MNE's home currency. But it doesn't affect the global sales price at all.
So it widens their profit margin.
Massively. It creates the illusion of perpetually cheap costs for the foreign investor. And this effect isn't just theoretical. We have concrete, rigorous data that shows this.
The Japan example.
Yes, particularly looking at Japanese FDI into China between 1981 and 2001. This data illustrates the profound magnitude of this engineering. During that period, the Chinese yuan cumulatively depreciated by a massive 82% against the Japanese yen in real terms.
82%.
Yeah.
Over 20 years. That's a powerful tool, but it seems to create a paradox. Because at the same time, we know that Chinese workers' wages were rising rapidly due to that explosive economic growth.
They were.
So how can the economy grow and wages rise, yet costs remain cheap for the foreign investor? That doesn't seem to add up.
It is the paradox that reveals the strategic success. To understand it, we need to look at two different ways of measuring labor cost. The first is what we call the Exchange Rate Free Wage Index, or EFW.
Okay, so this one strips out the currency effects.
It does. It measures the real wage of Chinese workers relative to Japanese workers purely in their local currencies. And just as you'd expect, because of China's rapid growth, the EFW shows that the real wage of Chinese workers rose more than 3 times relative to Japanese workers between 1981 and 2001.
So without a currency intervention, Chinese labor would have become 3 times more expensive relative to Japan over that period. And that would have quickly ended the cheap labor thesis and driven manufacturing somewhere else.
That is the conventional expectation. That's what should have happened. But then we look at the second measure, the Exchange Rate Adjusted Wage Index, or EAW.
And this is what the Japanese company actually sees on its balance sheet.
This is what they feel in their wallet. It measures the cost of Chinese labor for those Japanese MNEs adjusted by the actual exchange rate. And the data here is just stunning. It shows that despite 2 decades of rapid economic growth and genuinely rising domestic wages,
The cost was the same.
the cost of Chinese labor for those Japanese MNEs in 2001 remained virtually the same as it was back in 1981.
Let me make sure I'm getting this. The 82% strategic devaluation of the yuan completely absorbed the more than 300% increase in real domestic wages.
It completely neutralized it.
So the currency policy managed to satisfy 2 completely opposite demands at the same time.
Yeah.
Higher domestic living standards for the workers and stable, cheap production costs for the foreign investors.
It's an absolutely ingenious piece of economic policy engineering. The currency was the deliberate tool used to neutralize that rising wage pressure. It ensured that the cost advantage was maintained over 2 full decades.
So the foreign investor, like our executive, experienced this illusion of perpetually cheap assets and labor.
An illusion that made China an irresistible destination for export-oriented production, even as the local economy was booming and wages were rising for the local population.
And this engineered cost advantage didn't just attract a little investment. It caused a massive elastic surge in capital. It fundamentally reshaped where things get made on a global scale.
The surge was exponential. The real appreciation of the yen against the yuan translated directly into investment commitments. Analysis suggests that for every 1% real appreciation of the yen,
Making China cheaper for Japanese companies.
you saw approximately a 1.458% increase in Japanese FDI inflows. That is a highly elastic response driven almost entirely by that exchange rate advantage.
A multiplier effect.
Yeah.
You make the host economy cheaper by 1%, and investment jumps by almost 1.5%. So Where did all that investment come from? Was it new money or was it being pulled from somewhere else?
It caused a significant geographic rebalancing of investment flows. It was actively and deliberately displacing regional competitors.
Okay, so who were they competing with at the time?
Well, if we look at the data from 1990, Japanese FDI in China's manufacturing sector was only about 5% of its total FDI going into Asia's manufacturing industry. The majority was going to other places.
Right, to these so-called Asian tigers, or the ASEAN 4 nations.
Exactly. The rest was primarily going to the ASEAN 4, Indonesia, Malaysia, Thailand, and the Philippines, who were the existing export powerhouses at the time.
But that changed.
It changed dramatically. By 1995, just 5 years later, after the sharpest period of the yuan's devaluation, China had attracted almost half a colossal 47% of all Japanese FDI destined for Asian manufacturing.
27%. From 5. In 5 years.
China effectively displaced the ASEAN 4 as the top recipient. This strategic currency management was the key factor that triggered this massive decade-long shift. It fundamentally rewired global supply chains and established China as the undisputed primary global production base.
That systemic shift is the real lesson for that executive from the story. The glitch he thought he found was actually a carefully designed financial vacuum cleaner, pulling in his company's capital and its industrial know-how.
And it went beyond just production costs. The managed currency also raised the relative wealth of foreign investors when measured against domestic assets.
How so?
Well, with their home currency, the yen or the dollar buying so much more inside China, foreign investors gained immense financial leverage to acquire domestic assets. Things like land, factory equipment, even equity stakes in local companies. It just made everything look like it was on sale.
So the devaluation ensured this continuous capital injection, which allowed them to rapidly scale up their industrial capacity for their own national goals.
That's the mechanism.
Okay, so we've built the engine and we've attracted the capital. Now let's talk about the war chest, that $3 trillion hoard. How did that become a strategic weapon on the global stage?
This stage marks the elevation of the strategy. It's the move from simply managing the exchange rate to actively leveraging that generated wealth on a global scale.
It's not just passive savings anymore.
Not at all. It's deployed as financial statecraft to advance specific national interests and support key domestic economic sectors. The state realized it needed sophisticated vehicles to diversify its vast foreign currency holdings away from just low-yield government bonds.
They wanted to seek maximum returns while also fueling their long-term national development.
Precisely.
Let's introduce the major financial vehicle here, the China Investment Corporation, or CIC.
CIC was established in 2007. Its explicit mandate was to diversify China's foreign exchange holdings and seek those higher returns, but within an acceptable risk tolerance.
And how was it funded? Where did the initial money come from?
The Ministry of Finance issued special bonds to purchase a chunk of the reserves from the People's Bank of China. They then used that capital to fund the CIC, ensuring it was explicitly capitalized and leveraged from the very beginning.
And it's grown into an absolute behemoth. As a sovereign wealth fund, how large is it today?
As of the end of 2023, CIC's total assets stood at an impressive USD 1.33 trillion, with net assets valued at USD 1.24 trillion.
And what about its performance? Has it been a good investor?
Very good. Their investment philosophies are rigorously defined. Holistic thinking, a long-term investment horizon, and strict risk diversification. And their overseas investments have achieved a highly competitive 10-year cumulative annualized net return of 6.57%, which actually outperforms its own long-term benchmarks.
So it's not just big, it's effective. Now, we need to clarify the distinction between CIC's two primary roles because it operates both overseas and at home.
That's a crucial distinction. Functionally, we can think of it as having two faces. The overseas investment activities are managed by two subsidiaries, CIC International and CIC Capital.
And these are the ones that act like a global private equity firm.
Exactly. They operate like global venture capitalists and asset managers, investing in a diverse range of asset classes: public equity, fixed income, private credit, and direct investments in real assets like real estate, infrastructure, resources, and agriculture. Their mandate is to seek higher returns than traditional reserve holdings could provide.
And then there's the domestic face, Central Huijin. If CIC International is out there chasing global returns, Central Huijin sounds more like a stabilization arm.
That's a perfect way to put it. Central Huijin Investment Ltd. was actually established a bit earlier in 2003 with a distinctly domestic mandate. It undertakes strategic equity investments in key state-owned financial institutions in China.
The big banks, insurance companies.
The biggest banks, the biggest insurance companies, the biggest securities firms. It acts as a stewardship arm, ensuring the stability and optimization of state-owned financial capital. By 2023, Huijin managed about 6.41 trillion CNY, holding equity in 19 major financial institutions.
So these two roles, global returns and domestic stability, are managed separately, but they both derive their capital from the success of that overarching trade and currency strategy.
It's the ultimate financial toolkit. The funds generated by export superiority are not sitting idle. They're deployed as financial statecraft.
Let's dig into that. What are some of the specific focus areas highlighted in CIC's recent strategies? Because it looks like there's a real shift towards technologically advanced and future-oriented sectors.
There is. The 2023 strategy highlights several key commitments. One major area is sustainable investment. They're developing a distinctive model, integrating climate change considerations into their allocation and risk management. And they're actively increasing exposure to green energy and green impact funds.
Can you give us a concrete example of how that translates into an actual investment?
Sure. They invested in an innovative waste-to-biofuel company in Asia. They provided capital to support its production capacity expansion. Now, this isn't just a green investment for PR purposes, it's a strategic one.
Why strategic?
Because these advanced biofuels achieve a significant co-euro reduction compared to fossil fuels, which aligns perfectly with long-term national carbon neutrality goals. The investment secures both a financial return and a strategic technological advantage in a key future industry.
And what about in private markets, where the focus is often on securing new technology and future growth?
A very strong focus on private markets. Investments are concentrated in high-potential strategic sectors, TMT-SO, technology, media, and telecoms, as well as healthcare, advanced manufacturing, renewable energy, and data centers.
So all the industries of the future.
All of them. And they specifically use co-investment structures to reinforce their portfolio resilience and deepen partnerships with global technology leaders.
There's also a focus on resources and global supply chains, like in agriculture, which suggests a strategy to secure essential inputs for the nation.
Agribusiness is a huge strategic priority. They maintain a research-driven approach across the entire value chain. They invest strategically in key crop and livestock producing regions, but also in agricultural technology.
And this is where that bilateral synergies idea comes in.
This is the key leveraging point. They use the massive Chinese consumer market to enhance the growth of the companies they invest in overseas. For instance, their investment in a fruit and vegetable preservation company in South Africa wasn't just a financial play. They then facilitated its rapid access to the Chinese market, which simultaneously secured a food supply chain and dramatically boosted their assets' value.
That bilateral model, invest abroad, then use the domestic market as a growth multiplier. It's also designed to bring advanced foreign technology into their domestic ecosystem.
Absolutely. The France-China Cooperation Fund is a perfect illustration of this. It's a cross-border ecosystem designed to facilitate the entry of advanced foreign tech. They invested in a cutting-edge European ophthalmic device maker. CIC then worked with partners to facilitate that company's entry into China, introducing its advanced technology to local medical centers.
So it expands the investee's global reach while simultaneously supporting domestic modernization goals in healthcare. A win-win.
A strategic win-win.
Let's make this abstract financial power concrete. Let's look at the solar energy industry. This is a story of centralized power being deployed with just breathtaking speed to achieve global market dominance.
The solar industry provides a definitive case study for this. Around 2007, China's rapidly growing solar industry faced a severe threat. There was a critical shortage of polysilicon, which is the main raw material for solar panels.
And they were dependent on foreign production for it.
Totally dependent, and it was getting very expensive. It threatened to stall the entire domestic industry.
Now, the normal market response in the West would involve slow, incremental investment over many years. You'd have to deal with capital constraints, regulatory processes, environmental reviews.
Beijing's response was decisive and immediate. They declared domestic polysilicon supply as a national priority. That centralized decision immediately unlocked state guidance and immense financial resources. Money was funneled from state-owned banks and companies directly to key manufacturers, like a company called GCL Poly Energy.
And the timeline is what's so incredible here. An entrepreneur, a Mr. Zhu, raised $1 billion and built a major plant in just 15 months.
15 months. That kind of speed demonstrates that the regulatory and financial systems were not obstacles. They were active, coordinated tools of industrial policy. A process that takes years in the West was compressed into a little over a year.
And CIC, the Sovereign Wealth Fund, stepped in to backstop this national champion.
They reinforced it. CIC bought a 20% stake in GCL Poly for $710 million. So you see this complete financial deployment, central prioritization, rapid state financing, and sovereign wealth fund stabilization.
And the outcome?
Rapid and absolute dominance. In just a few short years, China transitioned from being dependent on foreign polysilicon to becoming the global leader. They secured their entire domestic supply chain and now control roughly half the global market for finished solar power equipment. It's an undeniable competitive advantage built with strategic capital.
Okay, so the economic model we've traced out here, the managed currency, state control over capital, strategic financial deployment, it stands in direct contradiction to the economic orthodoxy that dominated global policy for decades, the so-called Washington Consensus.
It's a fundamental anomaly when you view it through that lens. The Washington Consensus doctrines prioritized what was called shock therapy, rapid mass privatization, immediate market liberalization, and dismantling state institutions.
The idea being that markets would just instantly self-correct and generate efficiency.
That was the theory. But the contrast in outcomes between China's managed gradual approach and the nations that followed that rapid transition model is, well, it's deeply illuminating. It shows that strategic flexibility can outperform rigid ideology.
It's stark, isn't it?
It is. While China pursued its unique path, retaining strong state guidance, it registered sustained rapid growth. It achieved 9.3% annual per capita GDP growth in the 1990s. Now contrast that with the outcomes in countries of the former Soviet bloc, like Russia, which rigorously implemented those orthodox policies.
They experienced economic depression.
And catastrophic social metrics. Russia's per capita GDP growth as a terrible negative 4.7% for the entire decade of the 1990s. Even more tragically, life expectancy actually declined by 4 full years between 1990 and 2000.
4 years. That's not just an economic statistic.
No, it's a difference in human cost. A measurable outcome of the chaotic shock therapy transition that China was able to avoid by rejecting the wholesale dismantling of its state apparatus.
This suggests that the persistence of state-owned enterprises, the SOEs, and state control wasn't just some historical inefficiency that needed to be purged. It was a necessary institutional component for stability and coordinated growth.
That is the strategic conclusion. China's model successfully used what some analysts call market supplanting elements. These were institutions that defied the orthodoxy, like powerful SOEs and a complex web of checks and balances involving various stakeholders, local governments, workers, banks.
And they were a huge part of the economy for a long time.
A dominant part. In 1992, SOEs and collectively owned enterprises accounted for 86% of industrial output. Even by the turn of the century, that share was still a significant 64%. They provided an anchor for stability and coordination.
And this institutional resilience allowed them to execute a fundamental course correction when they needed to. Did their reliance on state management ever hit major turbulence?
Oh, yes. There was a critical period in the mid-1990s. It's called the high tide of neoliberalization, specifically the 1995-1997 drive to drastically downsize the SOEs. This resulted in severe social and economic problems.
What kind of problems?
Surging urban unemployment, slowing consumption. It created a genuine internal crisis.
And how did the state leadership respond? They didn't just double down on the market reforms.
No, they demonstrated remarkable policy resilience. Facing severe social resistance and economic instability, the state leadership executed a fundamental policy reversal starting in 1998. They decisively deployed market supplanting policies as a targeted anti-crisis strategy. They moved away from that orthodox liberalization.
What are some of those policies?
They included substantial Keynesian fiscal packages to expand investment demand. They rolled out welfare state policies to reverse stagnant household consumption. And critically, they implemented a policy aimed at revitalizing the state sector by improving the financial conditions of the SOEs and the state banks that supported them.
And they slammed the brakes on opening up the capital account.
Most importantly, yes. They decisively shelved the goal of liberalizing the capital account, re-emphasizing the controls that were necessary for the whole currency strategy to work.
That strategic flexibility, demonstrated by that 1998 reversal, it really allowed them to reject ideological purity. and instead focus on long-term stability and coordinated economic progress.
And that policy shift was entirely consistent with their long-term strategic goal of constructing a harmonious society. They prioritized capital deepening, industrial upgrading, and a type of growth that actually enhanced labor compensation. It was a demonstration of commitment to state-guided long-term stability over short-term ideological pressure.
Which brings us to the final piece of this puzzle. The success of this entire strategic engine, the currency management, the accumulation of massive FX reserves, it led to one final, inevitable, and circular consequence that really defines global economic interdependency today.
China's continuous buying of U.S. debt.
The interdependence trap.
You could call it that. It's the final loop in the currency mechanism. Those vast USD stockpiles accumulated by the PBOC have to be invested somewhere. And China views U.S. Treasury securities as the safest, most liquid, and most stable investment destination globally.
They prioritize safety and stability for that core reserve holding over higher returns from riskier assets.
For that portion of the reserves, yes, safety is paramount.
How large are those holdings today? What's the status of that financial relationship?
China remains the second largest foreign holder of U.S. Treasuries. They own about $759 billion as of December 2024. And this creates a deeply strange interdependency, a symbiosis.
It is strange because China is essentially loaning money back to the U.S. so that the U.S. consumer can keep buying the massive volume of goods that China produces.
It is a self-sustaining cycle. It secures China's export market. That is the essence of the mutual benefit. The purchase of U.S. Treasuries enhances China's money supply and creditworthiness, while at the same time, it enables the U.S. to buy cheap goods and finance its deficits at a low cost.
So the U.S. benefits from cheap goods and low borrowing costs, while China ensures the continuous demand necessary to fuel its export machine.
It's a delicate balance.
And this interdependency, it also creates a strong anchor against any catastrophic retaliatory financial action, like China suddenly dumping all of its treasury holdings.
Absolutely. The decision to sell off a massive volume of treasuries poses huge risks for China itself. It makes it a highly unlikely strategy.
Why is that?
A massive sale of treasuries would instantly trigger a decline in the value of the U.S. dollar. Since the RMB is managed relative to the dollar, this would cause the RMB to appreciate sharply. And that would raise the cost of Chinese exports overnight, immediately undercutting their price competitiveness.
It would destroy the very foundation of the system they built.
Exactly. China's continuous strategic need to ensure its export competitiveness means it will likely continue buying U.S. debt to maintain the currency structure that has worked so well for it.
So the weak currency was a calculated weapon used to create industrial dominance. But that resulting wealth now imposes a continuous obligation to secure the purchasing power of the very nation that serves as its largest customer. It's an engine of dominance, but it's built on a bedrock of strategic codependence.
It demonstrates a highly complex and successful economic model, one that is rooted in decisive policy flexibility and an unwavering long-term focus. It really confirms that managing the value of money was, from the beginning, a cold, calculated means for national advancement.
So to recap this deep dive, we've really traced a full strategic journey. It starts with a managed currency mechanism and ends with global financial statecraft.
That's right. We began by establishing the engine, how the currency was strategically managed, even suppressed, to generate a massive trade surplus and that accompanying hoard of foreign exchange reserves.
That initial step then created this huge financial advantage, a wealth effect, which was leveraged to attract vast amounts of export-oriented foreign direct investment. The strategic maintenance of cost competitiveness allowed China to rapidly displace its regional rivals and anchor itself as the core of global manufacturing.
And finally, we saw how this accumulated capital managed by these sophisticated institutions like the China Investment Corporation and Central Huijin was then strategically deployed. This capital was used to build national industrial champions like we saw in the solar industry, and to support long-term national development goals.
And in doing so, they successfully challenged the core assumptions of conventional market economics.
We have explored a successful economic model, one rooted in decisive policy flexibility and an unwavering focus on long-term goals. The success story of transforming currency management into a dominant industrial lever demonstrates how state leverage, when it's managed comprehensively across trade, currency, and investment policy, can completely reshape global competitive landscapes for decades.
It shows that keeping money worthless was indeed part of a cold, calculated strategy for national advancement.